This problem is similar to the one before, problem 6.01, except there is a salvage at the end of the project. Dog Up Franks is looking at a new sausage system with an install cost of $345,000. That means we're going to spend $345,000 at the beginning. This cost will be depreciated straight line to zero over the project's 5-year life, at the end of which the sausage system can be scrapped for $25,000, which means we're going to sell the system for $25,000. The sausage system will have saved the firm $85,000 per year in pre-tax operating costs, and the system requires an initial investment in net working capital of $20,000. If the tax rate is 34% and the discount rate is 10%, what is the NPV of this project? First and foremost, we need to calculate the cash flow from assets in year zero. Obviously, the net capital investment goes in as negative, the project cost. But since we're also making an initial investment in net working capital, that also has to be deducted. We are going to get this $20,000 back at the end of the project, even though problem doesn't say that we would. Now, for years 1 through 5, first we need to calculate the operating cash flow. Let's do that by calculating the depreciation first. Take the project cost, not the net working capital, just the project cost divided by project life, since we are doing straight line depreciation. Let's calculate the net income. The annual cost savings is the net income from this project because it is the incremental cash flow to the firm, minus the depreciation times 1 minus the tax rate. So there is $10,560 a year net income, but that is not cash flow. Take that net income and add back the depreciation. So there is actually a big annual operating cash flow. For years 1 through 4, that is the only cash flow because there is no capital investment or money from the capital or change in net working capital. So for year 1 through 4, that's what we have. On year 5, we have 2 elements. The first element is that net working capital is going to be returned back to the firm, and the system that we bought for $345,000 is now to be sold for $25,000. Of course, at this point, the book value of that equipment is zero because we have used straight line depreciation and we depreciated to zero. So take the $25,000 scrap value and calculate the after-tax value. So after taxes, we have precisely $1,500 in salvage value. So in year 5, we're going to take the annual operating cash flow, add back the initial working capital that is now returned to the firm, plus the after-tax salvage value. Then all we have to do is calculate the NPV using our NPV function, discount rate 10% of future cash flows, and deduct the initial cost. So that is negative $40,741.38.